Okay, so this is for the subject monetary policy and central banking. The video will be about the gold standard. So we have here an article from investopedia.com. Okay, so what is the gold standard? So the gold standard is a monetary system where a country's currency or paper money has a value directly linked to gold. Okay, so during the gold standard, countries can only print as much money as uh, same value as the gold reserves that they have. Okay, they cannot print more than that. So it essentially provides as a limit the gold reserves that they have, and that's why it's called the gold standard. The value of the money is based on the gold. Okay, so countries agreed to convert paper money into a fixed amount of gold. A country that uses the gold standard sets a fixed price for gold and buys and sells gold at that price. Okay, that fixed price is used to determine the value of the currency. So there's international trade already during that time, and so when a country transacts with another, normally they would pay using gold instead of the currency. Okay, and sometimes in the beginning they have allowed law of supply and demand to determine the price of the gold, but it poses its own problems to them, right? We'll go through that as we discuss the history later on. So that for example, if the US has the price of gold at $500 an ounce, the value of the dollar would be 1/500 of an ounce of gold. Okay, the gold standard is not currently used by any government. Everyone is using Fiat system now. Britain stopped using the gold standard in 1931, and the US followed suit in 1932, and abandoned the remnants of the system in 1973. The gold standard was completely replaced by fiat money, a term to describe currency that is used because of government's order or fiat that the currency must be accepted as a means of payment. Okay, so essentially it's an order and the people have accepted it as a form of currency or as a means of payment. In the US, for instance, the dollar is fiat money. For Nigeria, it's the naira. For the Philippines, it's the Philippine peso. Okay? The appeal of gold standard is that it arrests control of the issuance of money out of the hands of imperfect human beings. Okay? Because it will depend on how much gold is in the reserves of a certain country. Okay? With the physical quantity of gold acting as a limit to that issuance, a society can follow a simple rule to avoid the evils of inflation, which is, do not print more than the value of the gold reserves. So that's an easy rule to follow, right? But of course, there have been problems, which is why it has been abandoned. That will be later. The goal of monetary policy is not just to prevent inflation, but also deflation. Both are bad, increase in prices, decrease in prices, both are bad, right? And to help promote a stable monetary environment in which full employment can be achieved. So essentially what we're looking at is price stability, controlling the money supply to ensure that, there's no inflation, there's no deflation, and then full employment can be achieved by ensuring, essentially the reason why the money supply is being controlled is so that it could support the economic transactions happening, and with economic transactions that should translate to business operations, and through business operations more people should get jobs, so that would translate to employment, right? So the money supply should support the economic activities that we have. Okay. In some cases, I don't know if it's in this one or in a next video, it said that some countries would control the money supply at a certain percentage of the GDP, the gross domestic product of a country. And gross domestic product is measured as how much goods or services have been, sold in a certain country or produced in a certain country, right? Okay. And so, a brief history of the US gold standard is enough to show that when such a simple rule is adopted, inflation can be avoided, but strict adherence to that rule can create economic instability, if not political unrest. So it should still be based on what the country needs. Okay. Gold standard system versus fiat system. As its name suggests, the term gold standard refers to a monetary system in which the value of currency is based on gold. A fiat system, by contrast, is a monetary system in which the value of currency is not based on any physical commodity but is instead allowed to fluctuate dynamically against other currencies on the foreign exchange market. Okay? The term fiat is derived from the Latin fieri, meaning an arbitrary act or decree. So essentially, it's, by law. It was declared by law or mandated by the law that paper bills and the minted coins would be accepted as a form of money. And of course, the authority is only given to the central bank to produce such money. Okay. In keeping with this etymology, the value of fiat currencies is ultimately based on the fact that they are defined as legal tender by way of government decree. Okay? In the decades prior to the First World War, international trade was conducted on the basis of what has come to be known as the classical gold standard. Okay? So in this system, trade between nations was settled using physical gold. They actually used it as money, right? Nations with trade surpluses accumulated gold as payment for their exports. Conversely, nations with trade deficits saw their gold reserves decline. So as gold flowed out of those nations as payment for their imports. Okay. So essentially, it's been used as for international trades, between countries. So instead of using each country's currency, which not yet accepted as a form of currency, internationally during that time. So they only accept gold as a form of payment. Okay. So for example, a trade between the Philippines and the U.S. Why would you accept the currency of the U.S. dollars in that particular exchange when we're not using U.S. dollars in our economy, right? So instead of accepting U.S. dollars, they accept gold as a form of payment, okay? Because gold is essentially a universal commodity. It's been held as a precious metal everywhere in the world, right? Okay, so the gold standard, we have here the history. So we have gold because we cannot trust governments. This is a quote from President Herbert Hoover in 1933 in a statement to Franklin Roosevelt. So this statement foresaw one of the most draconian events in the U.S. financial history, the Emergency Banking Act, which forced all Americans to convert their gold coins, bullion, and certificates into U.S. dollars. So essentially, people who have gold on their hands, they have to exchange it into U.S. dollars, and all gold has been put into reserves by the central bank or the Federal Reserve. Okay? So they're the only ones handling all the gold. Not necessarily all the gold, but I don't think everyone really surrendered their golds, right? Well, the legislation successfully stopped the outflow of gold, because if a certain person would like to conduct a personal business or personal transaction with someone from a different country, then it would not be easy for the government to monitor the flow of the gold reserves, right? So they needed to have a centralized system on monitoring the gold reserves. Okay. While the legislation successfully stopped the outflow of gold during the Great Depression, it did not change the conviction of gold bugs, people who are forever confident in gold's stability as a source of wealth. Gold has a history like that of no other asset class in that it has a unique influence on its own supply and demand. Gold bugs still cling to a past when gold was king, but gold's past also includes a fall that must be understood to properly assess its future. Okay. A gold standard love affair lasting 5,000 years. So for 5,000 years, gold's combination of luster, malleability, density, and scarcity has captivated humankind like no other metal. According to Peter Bernstein's book, The Power of Gold, History of Obsession, gold is so dense that 1 ton of it can be packed into a cubic foot. Okay, wait. Cubic foot. Cubic foot. 12 inches by 12 inches by 12 inches. So, probably like this much. Height is also that much. Width is also that much. That's, oh, okay. Yeah, I'm just thinking how big it is. Okay. Preferably just, the size of your laptop maybe when you open it and then you close it in a box. Anyway, at the start of this obsession, gold was solely used for worship, demonstrated by a trip to any of the world's ancient sacred sites. Today, gold's most popular use is in the manufacturing of jewelry. Okay. Around 700 BC, gold was made into coins for the first time, enhancing its usability as a monetary unit. So it's been used as a form of payment, and it's been made into coins, it's been made into bullions. So before this, gold has to be weighed and checked for purity when settling trades. Okay. Gold coins were not a perfect solution, since a common practice for centuries to come was to clip these slightly irregular coins to accumulate enough gold that could be melted down into bullion. Okay, I think bullion is much larger than coins, right? In 1696, the Great Recoinage in England introduced a technology that automated the production of coins and put an end to clipping. Okay, since it could not always rely on additional supplies from the earth, the supply of gold expanded only through deflation, trade pillage, or debasement. So mining industry is not yet very active. And then the first great gold rush came to America in the 15th century. So you have mining. Spain's plunder of treasures from the New World raised Europe's supply of gold by 5 times in the 16th century. So there's an increase in supply. Subsequent gold rushes in the Americas, Australia, and South Africa took place in the 19th century. Europe's introduction of paper money occurred in the 16th century with the use of debt instruments issued by private parties, normally bonds. While gold coins and bullion continued to dominate the monetary system of Europe, it was not until the 18th century that paper money began to dominate. Okay, so there are still people, of course, resistant to change, right? Since they are used to using gold as money when paper money has been introduced, they could not, accept. Essentially, how do you value that? You have paper bills with different denominations, but essentially they're made of the same material, paper, although they do have some, security features so that they could not be produced by an ordinary person. It can only be printed by the central bank. But there are people who are, doubtful. How could this paper be valued 20 pesos? How could this paper be valued 1,000 pesos? Something like that. So there was the struggle between paper money and gold, and which eventually resulted in the introduction of a gold standard. So what is the gold standard? So again, the paper money being produced is based on the value of the gold in reserves, okay, of a particular country. So the gold standard is a monetary system in which paper money is freely convertible into a fixed amount of gold. In other words, in such a monetary system, gold backs the value of money. Between 1696 and 1812, the development and formalization of the gold standard began as the introduction of paper money posed some problems. Okay, because if there's no standard, then the tendency is for governments to produce as much, money as they need. But then, of course, they would soon find out that it would have an effect on the economy. It would cause inflation. It would lead to rising prices. So they have to, in a way, control the supply of money in the market. And one of the things that they did is by basing the limit on the gold, okay, the gold reserves that they have. The U.S. Constitution in 1789 gave Congress the sole right to coin money and the power to regulate its value. Okay, so before, of course, it was in the government, but later on it was given to central banks. Creating a unified national currency enabled the standardization of a monetary system that had up until then consisted of circulating foreign coin, mostly silver. Okay. With regards to gold and silver, because gold is seen as more valuable than silver, many people are reluctant to use it in trade. So instead of using the gold, they prefer using the silver, and they hold on to the gold as long as they can, and unless they have no more silver to spend, right? With silver in greater abundance relative to gold, a bimetallic standard was adopted in 1792. So they have silver and gold coins circulating in the market. While the officially adopted silver to gold parity ratio of 15:1 accurately reflected the market ratio at the time, after 1793 the value of silver steadily declined, pushing gold out of circulation, according to Gresham's law. The issue would not be remedied until the Coinage Act of 1834, and not without strong political animosity. So hard money enthusiasts advocated for a ratio that would return gold coins to circulation, not necessarily to push out silver, but to push out small denomination paper notes issued by the then hated Bank of the U.S. A ratio of 16:1 that blatantly overvalued gold was established and reversed the situation, putting the U.S. on the de facto gold standard. Okay, it's de facto because it's not official. Okay, that's what the word means. They're using it, but it's not official, or they're not admitting to having it. Okay. By 1821, England became the first country to officially adopt a gold standard. The century's dramatic increase in global trade and production brought large discoveries of gold. There are many mining companies, okay, which helped the gold standard remain intact well into the next century. As all trade imbalances between nations were settled with gold, governments had strong incentive to stockpile gold for more difficult times. Those stockpiles still exist today. So remember in the movie Default, financial crisis in South Korea during that time, the credits, right? The post credits. There were statements there saying that South Koreans donated their golds, and they were able to essentially donate a large amount of gold for their government, right? To help out in the financial crisis that they are experiencing at that time. So essentially, gold still has value, right? I don't think it would ever lose its value because it's a universal commodity accepted everywhere, and it's being seen as a very valuable metal, or what do you call this? In a way, it's seen as what do you call that? It's an expensive commodity, right? The International Gold Standard emerged in 1871 following its adoption by Germany. By 1900s, the majority of the developed nations were linked to the gold standard. Ironically, the US was one of the last centuries to join. So before they were essentially implementing it, but it's de facto unofficial. And then in around 1900, so that's when they officially adopted it. In fact, a strong silver lobby prevented gold from being the sole monetary standard within the US throughout the 19th century. So they're on a bimetal standard. From 1871 to 1914, the gold standard was at its pinnacle. During this period, near identical political conditions existed in the world. Almost everyone was using the gold standard back then. Governments worked very well together to make the system work, but this all changed forever with the outbreak of the Great War in 1914. So normally wars would really disrupt the financial system and the economy. There's no other way to put it. The fall of the gold standard. With World War I, political alliances changed, international indebtedness increased, and government finances deteriorated. While the gold standard was not suspended, It was in limbo during the war. Essentially, there's no one monitoring it, and there's no supervision whatsoever, demonstrating its inability to hold through both good times and good and bad times. This created a lack of confidence in the gold standard that only exacerbated economic difficulties. I mean, it's not the gold's fault, it's the war's fault, right? It became increasingly apparent that the world needed something more flexible on which to base its global economy. At the same time, a desire to return to the idyllic years of the gold standard remained strong among nations, as the gold supply continued to fall behind the growth of the global economy. Essentially, the problem with the gold standard is that there was a time that they fixed the value of it, I think $35 per ounce. But the problem is, with its limited supply, it could not equate to, the growth of the different economies around the world, because, more countries can produce more, year after year, whereas the supply of gold is essentially the same unless there are, gold rushes and supply of gold is increased, but it's unpredictable. So it didn't work out in that regard, right? Okay, so they want a more flexible, what do you call this? More flexible currency to use for the exchanges. Okay. The British pound sterling and the US dollar became the global reserve currency. Smaller countries began holding more of these currencies instead of gold. The result was an accentuated consolidation of gold into the hands of a few large nations. Okay. So with regards to international trade currently, majority of international transactions are in US dollars, right? When you buy online from a business that's situated overseas, normally you'd see US dollars as payment instead of course, our local currency, because essentially it's an international trade. Okay. The stock market crash of 1929, this is in the US, was only one of the world's post-war difficulties. The pound and the French franc, pound is, I think it's Europe, UK, the currency, and then franc, currency of the France, horribly misaligned with other currencies. War debts and repatriations were still stifling Germany. Commodity prices were collapsing and banks were overextended. Many countries tried to protect their gold stock by raising interest rates to entice investors to keep their deposits intact rather than convert them into gold. These higher interest rates only made things worse for the global economy. In 1931, the gold standard in England was suspended, leaving only the US and France with large gold reserves. Okay. So in 1934, continuing on, it's quite a long history, right? The US government revalued gold from $20.67 per ounce to $35 per ounce, raising the amount of paper money it took to buy 1 ounce to help improve its economy. Okay, so essentially, since the supply of gold doesn't increase, so what they did is they increased the value from 20 to 35, so they can print more money, right? So raising the amount of paper money it took to buy, as the other nations could convert their existing gold holdings into more US dollars, a dramatic devaluation of the dollar instantly took place. Okay, it's devalued because it's been, there's an oversupply, because when these countries or other nations sold their gold to the US, so the US had to supply the paper money, right? The US dollar. So essentially there's an oversupply of US dollars, and so what happens when there's an oversupply? There's surplus, right? So it's devalued in such that what do you call that? Is that equivalent to deflation? Not really, but if you consider the currency as a commodity, then yes, it's some sort of deflation, right? This higher price for gold increased the conversion of gold into US dollars, effectively allowing the US to corner the gold market. So because they increased, their price from 20 to 35, a lot of nations sold their gold, so the gold went to US, okay? Effectively allowing the US to corner the gold market because they have a majority of it. Gold production soared so that by 1939 there was enough in the world to replace all global currency in circulation. So the supply of gold caught up, with the development of the economies by 1939 due to gold production. It's not really gold production, it's more like mining, finding where they are. As World War II was coming to an end, the leading Western powers met to develop the Bretton Woods Agreement, which would be the framework for the global currency markets until 1971. So, exchange, right? Within the Bretton Woods system, all national currencies were valued in relation to the US dollar. So we have the exchange rates, right? How many Philippine pesos do you need to buy one US dollar? So that's how the foreign currency exchange rates began, okay? The dollar in turn was convertible to gold at the fixed rate of 35 pesos per ounce. The global financial system continued to operate upon a gold standard, albeit in a more indirect manner. So what happened was the currency equivalent to US dollars, and then the US dollars is the one being measured against the gold standard, right? So it's an indirect gold standard. The agreement has resulted in an interesting relationship between gold and the US dollar over time. Over the long term, a declining dollar generally means rising gold prices. In the short term, this is not always true, and the relationship can be tenuous at best. So as the following one-year daily chart demonstrates, in the figure below, notice the correlation indicator, which moves from a strong negative correlation to a positive correlation and then back again. The correlation is still biased toward the inverse, negative, and the correlation study though. So as the dollar rises, gold typically declines, okay? Positive correlation means, as one increases, the other also increases. And then you have the negative correlation. When one increases, the other decreases. So you have here, there are times that when it's, increasing, the dollar index is increasing, the gold futures also increases. But there were instances wherein the gold futures decreases, whereas the dollar index increases. So it's not, the relationship is hard to discern. Is it inverse or is it direct? Okay. At the end of World War II, the US had 75% of the world's monetary gold, and the dollar was the only currency still backed directly by gold. However, as the world rebuilt itself after World War II, the US saw its gold reserves steadily drop as money flowed to war-torn nations and its own high demand for imports. The high inflationary environment of the late 1960s sucked out the last bit of air from the gold standard. Okay. In 1968, a gold pool, which included the US and a number of European nations, essentially they're the ones who holds the gold reserves, stopped selling gold on the London market, allowing the market to freely determine the price of gold. From 1968 to 1971, only central banks could trade with the US at $35 per ounce. By making a pool of gold reserves available, the market price of gold could be kept in line with the official parity rate. This alleviated the pressure on member nations to appreciate their currencies to maintain their export-led growth strategies. Okay, so in a way, it's no longer based on the value of gold. However, the increasing competitiveness of foreign nations, combined with the monetization of debt to pay for social programs and the Vietnam War, soon began to weigh on America's balance of payments. With the surplus turning to a deficit in 1959 and growing fears that foreign nations would start redeeming their dollar-denominated assets for gold, Senator John F. Kennedy issued a statement in the late stages of his presidential campaign that, if elected, he would not attempt to devalue the dollar. The gold pool collapsed in 1968 as member nations were reluctant to cooperate fully in maintaining the market price at the US price of gold because it's been fixed. Why fix it, right? Again, fixing the value has its own issues. In the following years, both Belgium and the Netherlands cashed in dollars for gold, with Germany and France expressing similar intentions. In August of 1971, Britain requested to be paid in gold, forcing Nixon's hand and officially closing the gold window. By 1976, it was official. The dollar would no longer be defined by gold, thus marking the end of any semblance of a gold standard. So it all ended in 1976. In August 1971, Nixon subverted the convertibility of US dollars into gold. With this decision, the international currency market, which had become increasingly reliant on the dollar since the enactment of the Bretton Woods Agreement, lost its formal connection to gold. The US dollar, and by extension, the global financial system it effectively sustained, entered the era of fiat money. Okay, so again, everyone is using paper money. Okay, and still some printed coins, minted coins. Bottom line, while gold has fascinated humankind for 5,000 years because it's, glittery. Okay, it hasn't always been the basis of the monetary system. A true international gold standard existed for less than 50 years, from 1871 to 1914, in a time of world peace and prosperity that coincided with a dramatic increase in the supply of gold. The gold standard was the symptom and not the cause of this peace and prosperity. Though a lesser form of the gold standard continued until 1971, its death had started centuries before with the introduction of paper money, commodity-based money, a more flexible instrument for our complex financial world. Today, the price of gold is determined by the demand for the metal, and although it is no longer used as a standard, it still serves as an important function. Gold is a major financial asset for countries and central banks. Many central banks still have gold reserves, right? It is also used by the banks as a way to hedge against loans made to their government and as an indicator of economic health. In a way, it could be, when governments borrow money from international financial institutions or from other governments, they could use it as, collateral or as a way to show that we do have the money to repay the loan, something like that. Okay, it's considered a financial asset, of the government, of the central bank. Under a free market system, gold should be viewed as a currency like the euro, yen, or US dollar. Gold has a long-standing relationship with the US dollar, and over the long term, gold will generally have an inverse relationship. With instability in the market, it is common to hear talk of creating another gold standard, but it is not a flawless system. Viewing gold as a currency and trading it as such can mitigate risk compared with paper currency and the economy. But there must be an awareness that gold is forward-looking. If one waits until disaster strikes, it may not provide an advantage if it has already moved to a price that reflects a slumping economy. Okay, so essentially that's everything. We have the history of the gold standard, how it came into being and how it ended, right? So yeah, for now, all countries are using fiat money. Okay, although there is the emergence of digital currencies, Bitcoin, cryptocurrency. Maybe we'll tackle that some other time. But eventually, it's not regulated, it's decentralized. But as we've seen with, financial institutions, financial systems, when they are deregulated, it poses problems. And so I, for one, personally think that I have no faith in cryptocurrencies or digital currencies because they are deregulated. And as we've seen, most financial crisis, recession, depression are caused by the regulation of financial institutions. Okay, but anyway, they are not exactly financial institutions, but they could pose certain serious problems in the future. Just an opinion. Okay, so that's it for this one. We've discussed the gold standard. All right, thanks and bye.